Well, good afternoon. Happy Friday, July 16th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. It is a happy Friday. The adverse market fee is no longer. And what am I talking about with the adverse market fee? Well, the adverse market fee was announced last year at the beginning of the pandemic, and it was a 50 basis points fee designed to cover the losses projected as the result of the COVID-19 pandemic. The agencies anticipated they were going to see some pretty hefty losses, and so they input this fee that only affected refinance transactions in the United States. It was a half a point to price, not to rate, but to price, and it usually resulted in interest rates being an eighth to a quarter point higher than they normally would have been, or as they would be compared to a purchase transaction. So it always felt a little curious to people in my profession of why are we just going to impose this fee on refinances versus purchases, and is it exactly an adverse market? But a lot of it was what Fannie Mae anticipated was going to happen, or better yet, what the Federal Housing Finance Agency anticipated was going to happen. And so this half point fee, this 50 basis point fee, has now been removed effective for loan deliveries to Fannie Mae and Freddie Mac after August the 1st, which is fantastic news. What does that mean? Well, for today, it means nothing because this announcement came out after lenders had priced. But moving forward into the latter half of this month and on into August, we're going to start to see lenders improve their refinance rates as a result of being able to eliminate this 50 basis point fee. Now, some of this is just economic. Some of it is the job that Fannie Mae and Freddie Mac have been doing in terms of revenue, and some of it's political because the former head of the Federal Housing Finance Agency was a Trump appointee. He wanted to eventually take the GSEs, Fannie Mae and Freddie Mac, private. There was a big move to privatize Fannie and Freddie. Not so much with this new administration. Obviously, we have a change in the executive office. We also have a change now at the head of the Federal Housing Finance Agency, and there's no longer the impetus or the move to privatize these institutions. As a matter of fact, there's a move to sort of do the opposite, and we're seeing some of these fees or some of these policy changes that were implemented by the former head of the agency are now being reversed, which is an interesting sign. It's going to be fun for us to pay attention to. In the short run, it's really good news for homeowners because if you didn't take advantage of the refinance boom last year, you're going to have a new opportunity as we go into the next couple of months on and through the end of the year. With that being said, we have to pay attention to the calendar and what's on tap for the next Fed meeting. So the last Fed meeting here was June 15th, 16th, and we can see the next Fed meeting coming up July 27th, 28th. That's just about a week and a half away. And obviously, we're going to be paying close attention to that meeting. Is the Fed going to hint that they're going to pull back on their mortgage-backed security and treasury purchases? That tapering could cause a bit of volatility for interest rates. Is the Fed going to talk any more about when they may eventually alter the Fed funds rate? That latter part is probably a good ways off into the distance. The former, though, the tapering, that's something we'll really want to pay attention to with that Fed language coming up here in just about a week and a half. What's happening in the world of interest rates? Well, it's been a bit of a volatile week. We've got some inflation readings here midweek, and that sent mortgage-backed securities down by a healthy chunk, raising interest rates overnight. However, we gained a good bit of that back. It seems that mortgage bonds really are able to shrug off some of this inflation news that would normally be really detrimental, but they're really shrugging it off in light of what the Fed keeps saying, which is, hey, this is temporary. This is brought upon us by the fact that inflation is measured year over year, and this time last year there certainly was no inflation, so it's definitely going to look exacerbated compared to that. And then also the fact that some of this inflation is driven by supply chain issues, pent-up demand, incredible savings rate that we had last year. Folks are ready to spend money, and just things are more expensive because of the supply chain issues. So all of that stuff is going to be interesting to unwind as we get into the fall. And now that the adverse market fee has been removed, boy, we could see another spike in refinances, which is really good news for the country, really good news for homeowners who may want to take advantage of low interest rates to pay off other high interest debt like auto loans or credit cards or whatever it might be. If I can be of any assistance to you, please don't hesitate to reach out. Mark.Milam at highlandmtg.com, 404-395-1102. Have a good weekend.